And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is the second best day of the week. It is also the 80th anniversary of D-Day, the invasion of Normandy, right? When America entered the fray in World War II. Back then, President Biden set to deliver remarks. He is actually older than the event itself. So he was one. You know, he says he's done a lot of things, right? You know, his uncle was eaten by cannibals and all this other stuff. He could actually say, hey, I was there when Normandy happened, right? So D-Day happened. So he's 81, 80 years ago today, D-Day. So for our veterans that are still the few, I think there's still a few with us. There are, not many anymore, but we are getting that last of them. But our respects to those gentlemen. If you ever watch, you know, if you ever have not taken the time to watch some of the historical reels of the invasion of Normandy and what those guys went through, absolutely amazing. I mean, you know, the amount of bravery that those men had, I shouldn't say men, those boys had, because the youngest to die was 15 years old. So, you know, when you start talking about the amount of bravery these kids had, and I look at my kids, you know, my children at, you know, 18, 19, 20, and imagine them going off to fight in a war like this, the amount of bravery these people had was just something that's been lost in this generation. So I tell you, it's quite phenomenal, but take some time and go watch some historical reels and you'll get an appreciation of just exactly what these guys lived through. Anyway, couple of things. So ISM services came out yesterday, a little bit stronger than expected. Came out, showed an increase in service activity. Now remember, this is important, right? We see a lot of this manufacturing data that comes out and it's like manufacturing's weak, it's in a recession, it's in contraction. That's true, it is, but manufacturing only makes up about 20% of the economy. It's 80% services these days. So if services are an expansion, you're not going to have a recession. You have a very slow economic environment, but you're not going to have a recession as long as services remain in expansion territory. And we saw a big jump yesterday in services. Now, the one thing interesting about that report, though, was prices weakened, their input prices weakened, and employment weakened. So we are starting to see some deterioration even in that services sector that's more disinflationary than not. But again, overall, we saw a jump in services. Now, it's not really surprising because services has been just really kind of just bouncing around right on that contraction line. So, you know, last read was a little bit below it. Now we're back above it. And it's just really kind of struggling to maintain that balance between expansion and contraction. And that has a little bit to do with simply that you know, consumers kind of need access to services for different things. And so they may put it off for a little bit, but then I can't put it off any longer. I've got to do whatever it is I've got to do. So that's why you kind of get these bounces back and forth. It's just the consumer starting to kind of reach the end of that road. So you see that type of activity occur. But nonetheless, that does suggest the economy is not in a recession yet. But again, doesn't negate the fact that the economy is actually slowing down. The trend of service growth has been declining now for quite a few months. So again, the economy is slowing down. We see this data in things like the Atlanta Fed GDP now. We talked about that yesterday. That's been revised from over 4% to 1.8%. So a big drop in just a month. In the economic data that the Atlanta Fed tracks. So again, just it's important to kind of keep this balance. Again, a lot of people, a lot of commentary, a lot of headlines out. You know, it's like, oh, recession's definitely coming. Maybe it is, but right now the data doesn't support it. Because again, once you start getting services into contraction territory, now you've got the real risk of a recession. So, I mean, that tells you that the economy is slowing down fairly sharply. Now, we have some other data that suggests that ISM is going to follow suit and that ISM will go into contraction territory over the next few months. But again, it's all kind of right at that borderline of recession, non-recession. So again, we're not into a deep contraction, but we are definitely slowing down. So again, that's going to be important, and this is something we're touching on this weekend in the newsletter, is that if you take a look at earnings estimates going into 2025, they are a 45-degree angle in growth. There is a very large expectation of 20% earnings growth going into next year. That's going to be difficult to generate if the economy is slowing down, because earnings obviously come from revenue. Revenue comes from economic activity. So just something to pay attention to. All right, let's talk about the big elephant in the room, shall we say. And this is what you need to know before the bell this morning. Nvidia yesterday, big day on Nvidia. Here's a chart of it. $3 trillion in market cap. It is now the second largest market cap weighted company in the S&P. It overtook Apple yesterday. So again, a very, very big move for Nvidia yesterday. Just a couple of things technically. Now, this has nothing to do with the story behind Nvidia, the AI chase, all that, right? This has nothing to do with it. This is strictly technical analysis. But and again, just disclosure, we're long Nvidia in our portfolios. We took profits in Nvidia just before earnings, because again, it was already very overbought. And, so again, we just rebalanced back to target, and that's all we did. So we're still long the position. But Nvidia is now trading well into 3 standard deviations above its 50-day moving average. So again, it's a very extended move above its 50-day moving average. The last time that it did this to this degree was back in March, and it spent a couple of months then really kind of declining and working off that overbought condition. You'll see here that at that same time back then, the MACD as well as the TRIX indicator were both very elevated, and they kind of worked off some of that elevation. Again, just these overbought conditions have to be reversed at some point. Doesn't mean you're going to have a major decline in the stock price at all. That's not what it means. It means that you could go through a period of consolidation where literally the stock just doesn't go much of anywhere over a month or 2 or 3 while it works off some of that overbought condition. Now, here's the problem though with this, and again, we're just getting really kind of ahead of ourselves in terms of the potential of earnings growth and revenue growth, et cetera, going forward. Remember, it's kind of the law of large numbers that, when you start looking at this stock over a longer term basis, it has been rare, and you have this massive push higher in both the MACD and the TRIX indicators that are at levels that we've basically never had before. So again, it's just a very, very big overbought condition on multiple levels, and this rally, particularly for Nvidia that has started in 2024, has been really outsized relative to what we've seen previously. In fact, if we just kind of go back in time, we just haven't seen this type of a sharp move. And again, we start looking at the MACD and the TRIX in terms of their magnitude of movement. We've just never seen this type of a magnitude of movement before. Now, again, that doesn't mean the stock is going to crash. I'm not saying that at all, so don't take it that way. But just understand that this move has really accelerated. Everybody's chasing this one stock, really. It's just this one stock. And particularly if you take a look at the theme of the market, it's pretty much, as we saw yesterday, the Mag 7 now makes up 31% of the S&P. That is up from 6% in 1990. If you take a look at the movement in the market yesterday, something we touched on our daily commentary this morning, it is all back to the Mag 7, particularly Nvidia, Microsoft, Amazon. Everybody related to the AI chase is where money flows are going. That's fine for right now. Just understand that these moves are getting very, very extended, which at some point we're going to have to see some of that worked off at some point through some type of corrective process, either consolidation or correction. Just something paying attention to. Don't forget to take profits, manage the risk in your portfolio. Okay, that's what you need to know before the bell this morning. We'll come back, pick up with Michael Leibowitz. Lots of stuff to get into. Is the Fed going to cut rates in June? Talk about that next.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Of course, Michael Leibowitz joining me as always on Thursdays as we get ready to kind of wrap up the trading week. And it's been a good week for the markets. Markets hit an all-time high yesterday. That's not surprising. Again, we're have been kind of consolidating over the last few weeks, trading within this range between all-time highs and basically the 20-day moving average. And so we bounced off that 20-day moving average earlier in the week. And, so this moved all-time highs yesterday. Not surprising. Again, marginal new highs, but everybody gets excited. It's like, oh, new highs. Yeah, it's marginally a new high, but it's within the realm of context that, we're still kind of consolidating here. And again, as we said before, the markets can certainly make a new high. That's certainly not outside the realm of possibility. But again, upside is likely limited here just in the short term. But we'll see. We'll see what happens here. But again, everybody's very excited. It's all about the AI chase. In fact, Mike's article on the website this morning is part 3. Are you done with this yet, Mike? On the power generation for AI? Did you finish? You were able to get to the 3, not 4, huh?
I'm done. I can't do anymore.
So yeah, part 3 on we've been right. He wrote a series of articles. We've been discussing this over the last. Both he and I have been discussing this over the last couple of weeks. I have an article out last Friday as well, talking about the impact of the expansion of the power grid. My article was more focused on the economic benefit and a lot of concerns about our debt issuance and how that's going to be a problem, and what this build out of the electric grid does potentially is provide us productive investment for a change that could actually improve economic activity and economic prosperity across the country. Mike's article really takes a look at, or series of articles actually takes a look at the demand for power and what's that mean for the investment side of the vehicles. And again, Mike, you and I have been talking about this for a while, is that in our portfolio, we're looking for some of those, starting to build in some of those infrastructure type opportunities that are going to be the byproduct of this need for electricity.
Right. So this was a longer endeavor than I expected, but I also think it's going to be something that we're investigating for years because it's going to be changing as the power grid is built out. And when I started doing this, my thought was I would lay out the longer term thesis in part one. Part two would deal with all the energy that supplies the power grid. And then part three would be the power grid itself on actually expanding it. Well, I got to part two, and we talked about nuclear, natural gas, a little bit about coal, and I started, getting into alternative energies, and that's almost a section unto itself, a full article. So I decided to push that off to part three. So alternative energies are really interesting and really difficult investment play. Now, we know that renewable alternative energies, people use both terms, they basically mean the same thing, are roughly about 20%, they power roughly about 20% of our power grid today. They expect that number could easily double. And if we stay with this whole net zero emissions, we're not going to get political, but if we stay, I'm not going to get political here, but if we stick to that, alternative energy is going to have to increase significantly. So, the question is, as an investor, what's the deal with alternative energy? Because it's great in the sense that the emissions are next to zero. They're very safe. The problem, however, is they're a flawed technology. The most obvious is weather. If you have solar or wind, you're very dependent on the weather. And there are certain places where you just can't have solar or wind energy. So that's a problem. They're also not efficient, or not nearly as efficient as more carbon traditional based energies. They're roughly about a third of the efficiency of some of those other energy sources. And the other thing that people don't really think about with electricity is some of the raw materials that feed them, like lithium for batteries, is not. First of all, some of these metals don't come in places that are very politically friendly, that are cheap to mine. Some of them there are shortages of. So just the ability to get some of these metals can be a difficulty. So when you're looking at this space and you're saying the power grid's expanding, but if you look at the stocks, the wind stocks, the solar stocks, they've been doing really poorly. And I think the problem with investing in, I think that there are potentially some really good opportunities, but we have to address the battery issue. So with solar, we'll use solar as an example. You produce solar during the day, you don't really get it at night. And you could have, your peak demand and demand hours for electricity vary, and it varies by the weather too. So you need something to store the electricity, and we do have batteries, but they're not great. So one investment idea is to figure out who's going to make that great battery that's going to allow for solar to be more efficient in regards to when you can offer what you've quote unquote mined already. And then, the question is, well, what's the battery going to be? Is it going to be the lithium ion battery that we all know? Because there's about 10 other batteries in the works right now that some have lithium, some don't. And so it becomes a kind of combination of technology game. It's really a technology game. And what will be the technology for year 2027, 2030? And it may be very different technologies than we have today. And the same with alternative energy. Could be hydrogen, could be, some other alternative energy source. So our recommendation for that space is, unless you're really in the weeds on this stuff and really know what you're doing, some of the ETFs may offer a better alternative to investing in this.
Yeah,
so you get some diversification.
Yeah, just where you get a whole basket of, kind of just take a shot at the basket of alternative energies or, utilities, et cetera, rather than trying to pick the company. Because again, that's been one of the big problems is with individual stock picking, is that you can buy the company that you think is going to be the winner, and it's another company that turns out to be that case.
Right.
And it's just very hit and miss because it's still early in the cycle, and it's very hard to determine, who's going to be the winner in that space. And again, many times it turns out to be the one company you didn't think it was going to be.
Right. And, we can go back and look 25 years ago, and you had Sun Microsystems and Yahoo. There were some AOL, right? They were the leaders. They were the ones that were going to dominate the industry. If they exist, it's barely right now. Some of the, there were some companies, no one heard of Nvidia back then. No one heard of a bunch of companies that were basically tiny companies back then, if they even existed, are the ones that ended up powering the internet.
Right.
So be careful. It may not be Nvidia, for instance, building chips for data centers in 5 years. It may not be ChatGPT as the main AI source. I mean, that's the tough part with investing in technology. And it's something you have to be really careful on and be ready to buy and sell and trade that thesis a little more than something like the first part where we talked about natural gas and nuclear. Those are steadier, they're dependable. We know what they are. We know which companies are dominating and will most likely dominate. So that's always the interesting challenge, is everybody's always looking for the next Microsoft, the next Nvidia. And remember back in the 1980s, there was a dozen different computer companies. There was DEC Computers and a whole variety of others, and none of those even exist anymore. And so trying to find that one company that's going to be the next Microsoft, the next Apple, the next Nvidia, the next Google, it's very, very tough to do. So sometimes buying a basket is just better, and then you at least get to participate. And then once you start to see the emergence of the next Microsoft, the Amazon, the Apple, then you can start focusing on investing in that company. Correct. And, given, first of all, the alternative energy stocks have really been beaten down. And it's political too. Right? If Trump wins, do we get rid of the zero emissions by 2050? If Biden wins, does he double down on that and say zero emissions by 2040? So it's a very political hot potato that can,
and that's a great point, because it's also about subsidies, right? And if Trump gets elected, he provides, maybe he goes back and saying, hey, I'm going to support the oil and gas drilling industry and provide subsidies for oil and gas drilling, and I'm going to take them away from the clean energy, and again, because we've seen subsidies go out for EVs, et cetera. So again, it's also on the political front, which industries are also getting those subsidies and support, tax credits, et cetera, to help those companies grow.
And just think about that. They need subsidies. That means they're not really efficient enough from a financial point of view.
Right.
That tells you what you need to know. Now, at some point they may be or will be, but right now they're not.
And the subsidies still don't go away. As with the oil industry.
Maybe not. But it tells you a lot about the financial efficiency of these alternative energies.
No, that's absolutely right. Okay, so we're going to come back from the break, switch gears, talk a little bit about economic data. The Fed meeting is coming up, I believe, next week. So we'll talk about, Fed rate cuts. Of course, that's why the market's been rallying over the last few days. Weak economic data has now gotten everybody very excited once again about rate cuts. And we'll talk about that when we come back from the break with Michael Lewitz. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
In the last 2 years, there's been a massive drop-off. Like, nobody's naming their kid Alexa anymore. But yeah, because you go, Alexa, stop that, and all your lights go off.
The Real Investment Show podcast.
And I'm sure the kids at school were getting teased. You know, hey, Alexa, ask a question.
Same show, your schedule.
I hadn't heard of any kids being named Siri.
Not yet. I'm sure there are. I am sure there are. And there's probably some kid named Bixby somewhere.
At realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. All right, let's talk a little bit about Fed, that meeting coming up next week. Markets all just focused on, really, is the Fed going to cut rates or not? After the latest batch of economic data, which has come in a good bit weaker than expectations, we've now seen rate cut odds go to 2 this year. Remember, this has been a big gyration for the markets. Even though the markets are making all-time highs, remember, this all started back in 2020, what year is this? 3, that we were at 7 rate cuts for this year. And the market was rallying because we're going to get 7 rate cuts. And the Fed was like, no, we're going to give you 3. And then the Fed market's like, no, we want 7. The Fed's like, no, we're going to give you 3. And since then, the market not only came to 3, they actually got down to 1. And have now come back up to 2. So again, the market's going to settle at 3 rate cuts this year. The Fed's still at 3 rate cuts. I think we'll figure this out. The question is, will the Fed cut rates on, Wednesday next week or not?
The answer is no.
Yeah, pretty much.
0. And actually, if you look at Fed funds futures, they say there's a 99.7% chance they do not cut rates.
Right.
So that's about as close as perfect as you can get in a financial market. The bigger, Lance, the bigger question, though, is what are they going to do for the rest of the year? And this year is a little unique because there's an election. And the Fed tries to be independent. So what does that mean? That means that they probably, unless things are, really deteriorating in the economy, will not do anything. There's a meeting in mid-September. They will not do anything at that meeting. So they only have 2 meetings, the one next week and one at the end of July. If they're going to cut rates, then there's a meeting right after the election and one in mid-December. So they could cut at both of those meetings after the election, so they're not seen as influential. But they're not going to cut tomorrow, so it kind of leaves July 31st as the next possible hike. And right now, that doesn't really seem possible. But we have...
But a lot of that would depend on, if employment all of a sudden falls off the cliff, right? Or something like that,
Right. There's 2 more unemployment numbers, 2 more CPI numbers, 2 more retail sales numbers, basically 2 more sets of monthly data. Plus, the Fed has some of the data before it's announced. So because the meeting's at the end of July, they'll probably have a good feel for what the next unemployment number will be and somewhat of a feel for inflation. And at this point, as long as inflation is not increasing and it's kind of trending slightly lower and it's on the lower side of where it's been, I think a decent dip in employment, something like where we're adding 100,000 jobs a year for the next couple months could be enough to get them to do a token 25 basis points. The Bank of Canada just cut rates, I think it was yesterday, by 25 basis points. Their rates tend, just like their economy, tend to track the U.S. really closely. So usually the 2 lines are almost on top of each other. We often lead, but this time they cut rates first.
And the ECB is expected to cut rates also.
Right. Different scenario. UK as well. So the rest of the world is cutting rates or going to cut rates pretty soon. And more often than not, the world central bankers work together, because if someone's really cutting and someone's raising rates, currencies get completely out of whack, and that can have a big economic effect. So they try to, while it's certainly not one monetary policy for all, they tend to generally have similar monetary policies. So look, the next Fed move will most likely be a rate cut. It's really a question of when, and is it just a token rate cut or two, or traditionally the Fed doesn't do token rate cuts. They cut, they're really cutting. They're going to drop 2, 3, 4, 3 or 4%. They're going to bring rates much lower. So could it be a token cut? Sure, but history tells us once they start cutting, they cut aggressively. But, the economic data, like you started off with early, does not point to really any need for rate cuts at this point. There's certainly been some slowing, I would say moderating. We've just had a very hyper economy for the last few years due to all the stimulus. And we're getting back to a more normal operating rate for the economy. Yes, 5.25% Fed funds is too high for the economy we had before the pandemic, and they will cut because of that. But it doesn't mean that we're going into a recession either. It means that they're moderating interest rates just like the economy is moderating back to kind of a steady flight level at this point.
So I guess this is, but again, this is, one of the risks to the markets is markets are anticipating these rate cuts, which is why we keep rallying the market, right? The market, Fed's going to cut rates, increase monetary accommodation. That's going to be good for stocks. Lower rates good for stocks. Lower rates good for bonds. But we haven't quite gotten to those rate cuts yet, and the data, to your point, it doesn't really suggest that the Fed should be aggressively cutting rates here. It is starting to work in their direction. We are seeing inflation come down a bit in terms of prices. We're in terms of like prices paid, some of the ISM services indexes, et cetera. We're seeing unemployment weaken. Yesterday's ADP employment report, kind of spoke to that a bit. But again, it's nothing dramatic, right? Nothing that would suggest that the Fed needs to aggressively cut rates here to try to stave off an economic recession. So it's really the question of, does the market get disappointed here that the Fed's not moving more quickly on cutting rates.
Well, here's the funny part with this conversation is that if you just go back and look at history, markets do well when the Fed is raising rates.
Mm-hmm.
They do okay when the Fed is kind of, in that hold period, and they do poorly when the Fed's cutting rates. So the market should not really want the Fed to be cutting rates because, like I said earlier, when they cut, they're cutting drastically, and they're doing it because the economy is usually in a recession, or there's a financial crisis, or there's something else going on. But this time could be a little different. We use that term a lot, but and why I say that is, well, if we don't go into recession, and I'm not saying we are or aren't, but if we just kind of steady out with weaker growth, the Fed may want to do just a few token rate cuts, not cut rates drastically, and leave it at 4.25%, 4.5%, which is still a very high rate, even compared to the economic growth and the inflation. But they may want to just do a few token cuts, which could be perceived as bullish for the stock market. I think where the stock market would really struggle is when we have 7 rate cuts. Like
right.
It's pretty funny. The market was rallying on 7 rate cuts because the Fed isn't cutting 7 times unless we're going into a recession.
Right. Which again, and the whole point about that is that if the Fed is cutting that aggressively, all of a sudden these more ebullient earnings growth expectations of 20, 25% next year are not going to materialize. And all of a sudden the market has to reprice for slower earnings growth. So, I mean, it's a very interesting conundrum the market's gotten itself into. But again, it's everybody needs a reason to buy something. So this has been the reason to zeros the late. Oh, the Fed's going to cut rates, easier monetary policy. The real hope is really not rate cuts. It's not lower rates. It's QE. That's really what the market wants, which is they want the Fed to start monetizing debt, start stimulating the monetary system through the bank credit facilities. So, it drives prices higher.
But QE is very hard to see anytime soon, right? Unless we have a recession or unless there's a banking crisis.
Right.
Maybe they'll reduce the amount of QT further. But it's very hard to see QE in any kind of bullish stock market environment right now.
No, that's right. I mean, absolutely. So, I guess, the when it comes to kind of the outlook for, the rest of this year, it's difficult to predict where this market's going to be. And again, I think there's more risk of a disappointment coming over the next, couple of months, particularly heading into the election, than not. I mean, so, we've had a good run. And again, kind of like last year, we were kind of in the same position in June, July of last year. Market was up 15%, 16% in June and July of last year from the start of the year. And then we had that 10% correction. And, we're kind of set up for that same environment. It doesn't mean this year won't end on a positive note, but, it certainly seems like we're in a position for a decent correction, probably sometime this summer, to kind of work off some of the exuberance, particularly when you look at stocks like Nvidia and some of the AI-related stocks. They just simply need a breather here at some point, just to kind of get expectations back in line with reality.
The big but with that, though, is the election.
Yeah.
And how will the market perceive whoever is winning the polls? What does Trump mean for if Trump is president, and does he get the House and Senate?
But you got to be careful of that, though. I mean, I remember in 2016, I was on the floor of Fox News during the election night, thing, and the whole belief is that if Trump got elected president in 2016, the market would crash, and it did for a second. We were down like 500 points when the polls were coming in, and Trump was in the lead, and then the market just took off rallying after that. So. You got to be careful with the election, because markets tend to do weird things around elections, period. So, all right, quick break. We're going to come back, wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Interesting article out on MarketWatch this morning talking about small cap stocks. And, you know, it's just been a very lackluster performance for small caps in recent years, and really kind of going back for the last 6, 7, 8 years in particular. Small caps have vastly underperformed large cap stocks. In fact, if you just take a look at the breakdown of returns from the S&P really since 2014, obviously NASDAQ, S&P at the top, and at the bottom, emerging markets, international, small cap, mid cap. So, and again, it's just, part of this, and this is always kind of one of the anomalies that people go, well, small caps haven't performed yet, so they're going to play catch up. And that's potentially a case, right? But what drives small cap stocks in particular, which is economic strength. You really need an economy begin to recover. And small cap stocks in particular are very, very exposed to economic activity, much more so than large cap companies. So large cap stocks have the ability to very easily go to market, raise billions of dollars of capital, either through debt or secondary share offerings, whatever it is. Very easy for them to do that. Share buybacks, of course, which have accounted for roughly about 40% of the gains in the market since 2010. That's a large cap thing, simply because they have the capital, or they can, Apple took out $5 billion in debt to buy back shares. We saw General Motors do that before they went bankrupt previously. So, the large cap companies have the ability to support asset prices, as opposed to small caps and mid caps, which don't have that capital and are more exposed to just raw economic activity and what's happening. And so this is one of the reasons we don't own a lot. We do have some small mid-cap companies in our portfolio, but very selective. And they're for very specific points on why we own them. But we don't have a lot of small cap exposure for that reason, is that they are very economically sensitive. And if economics are slowing down, not speeding up, that's going to weigh on their profitability. And this is the important point. If you take a look at profits, right, where are profits of companies coming from? Where are earnings? Profits, earnings, almost interchangeable. If you strip out the earnings growth in the top 10 companies, there is no earnings growth for the S&P 500. In fact, there's negative earnings growth for the S&P 500 once you strip out the top 10 stocks in the index. So again, this is why we have a lot of market concentration right now, right? As I said earlier in the show today, the top 10 stocks make up, the Magnificent Seven now make up 31% of the overall index. It's a very high level of concentration. Now, that doesn't mean the market's going to crash tomorrow. We've had periods of high concentration before. It's just that's where all the profit and earnings are being generated. So people are buying those stocks because those are the ones that are generating the earnings and the profits. The other 493 stocks, mid caps and small caps, aren't generating the earnings right now, and that's being reflected in some of the economic data. So it's a will there be a point where small caps are the place to be, and you'll want to have a lot of exposure to small and mid caps? Yes, that's most likely going to be after we go through a period of time of very slow economic growth or recession, work off all this excess stimulus that's been thrown into the system, get back to some level of normalcy. And then we start to see the economy recover across the breadth of the economy, where small caps and mid caps are also generating earnings growth, not just the largest of companies. Mike, your thoughts?
Yeah, so I'll talk about interest rates and how they affect small caps in a second. But as you were going through that, if you have a small cap company that's really growing fast, well, what happens to it? It becomes a mid-cap company. It becomes a large cap company. So companies that are really growing fast that are small caps don't stay small caps. So what you're left with are companies that are, like you said, growing with the economy. Some a little quicker, some a little slower. But you don't have your Nvidias that are growing at, over 100% a year, or 20, 25, 30% a year, because eventually they get out of that small cap classification.
Well, sorry to interrupt you, but just a great point about that is Supermicro Computer, which was a small cap company. It was trading around $200 a share. It was a small cap company. They make computers that are in the AI space. People figured that out. It ran up to $1,200 a share, and the S&P took it out of the small cap index and put it into the large cap index. So now it's an S&P 500 company, and subsequently lost 40% of its value. So I'm not sure S&P is happy about that part, but right. But to your point, Mike, it was small cap. Now it's large cap.
And I bet Nvidia was small cap at one point 15 years ago. Mm-hmm. And if let's just say the Russell kept Nvidia in it, the Russell small cap index would be doing really well right now. So, it's just a question of who's in that, which stocks are in that index too. But also, those companies tend to borrow a lot of money as a percentage of their equity. They borrow more than larger cap companies in general. So we're in a high interest rate environment, and these small cap companies don't really have access to debt, to borrowing money like the large caps. The large caps can issue debt all day. They go to Wall Street and borrow money. They can easily go to banks and borrow money. Smaller companies, a lot of them can't issue debt. They're just not big enough. And they go to banks, but banks are not really lending money out right now. So they're paying higher, at the right price, they'll lend money out. So they're paying a higher price for debt. And it's also weighing down on their earnings. So what the Fed is doing with higher rates is certainly affecting, we've talked about commercial real estate. It's really putting a hammer to the commercial real estate market, but it's also weighing heavily on small cap stocks, especially those that have to borrow in this market that did not borrow a lot of money in 2020 and 2021 like a lot of the large cap stocks did.
Mm-hmm. Yeah, that's right. So again, it's just important. And look, the same thing goes with emerging markets. There's lots of articles I see on a regular basis where, emerging markets valuations are cheap relative to the U.S. And that's a true statement. Those valuations are cheap relative to the U.S., but they're not necessarily cheap relative to themselves. And, emerging market countries are exporters. They depend upon importers like the U.S. to import their goods. And so it's not really a fair comparison to say, well, go buy emerging markets because they're cheap relative to the U.S. It's really, are they cheap relative to themselves? And what does the current economic environment say about their future prospects for exporting goods or services to the U.S. and to the developed markets like Europe, et cetera, because that's where their revenues come from. And
right.
The consequence of that has been really that emerging markets have vastly underperformed the S&P 500 and U.S. stocks in general over the last several years.
And here's the other thing. All indexes are not created equal. So when you look at like the emerging market index, it's a lot of commodities that tend to trade at low valuations. And it's not commodity stocks that are leading the way now, it's technology stocks. So if you take a foreign stock index and take the S&P 500 and reweight the S&P 500 for the weightings that are in that foreign index. So let's say in the S&P 500, technology is 25%, but in the German index, it's 10%. We would bring the S&P weighting down to 10%. And when you do that, our valuations are certainly higher, but they're not much higher like some of these pundits are saying.
Right.
The valuation difference there is a valuation difference, and some of that is because we're in America, and America has a higher growth rate than most countries. And it's, there are many other reasons that American stocks tend to do better over time than foreign stocks. So when you factor all that in, there's not as much value in foreign stocks. That being said, if there's a country that you think is going to start doing well, much better economically for whatever reason, that's a different story. But just solely on the basis of valuations, you just can't look at both two numbers and say one's cheap, one's expensive.
Well, that's right. And, this is, why it's important to, do the analysis and not really just, again, there's so many headlines that come out, from the media, touting one thing or another. It's important to, look behind it, not just take some headline at random and say, oh, well, this manager says valuations are cheap, buy emerging markets. You got to be careful because he's an emerging markets manager. Or if a guy says, hey, buy small caps because small caps are cheap. That may be true, but he's also a small cap manager, and that's what his book is. So, and there's nothing wrong with that, right? I mean, if I was running a small cap fund, I'd be out buying small caps now because my job is to run a small cap fund. That's what I do. We don't do that. We run a multi-discipline portfolio, so we can buy anything we want. So that gives us a little bit more flexibility. But it's always important to make sure that when somebody comes out and says something, always say, okay, well, why are they saying this? What's the bias to that argument, so that you can understand if it's the right investment for you and what you want to do with your finances and your money going forward.
And the question du jour that we're getting from both clients and other people is, Joe Blow said I need to buy gold because it's going to 4,000, 5,000, whatever, because of A, B, and C. Gold is going to be the place to be. Well, the first question you should ask Joe Blow is, how does he make money? What does he do for a living? And a lot of times you'll find that there's some link to selling gold or making money if gold goes higher. So, like with anyone, just be careful. Anyone selling anything, just understand what they're selling and what their motivation is.
Right. Buy Nvidia because we have a ton of Nvidia stock to sell. So
Exactly.
Joking. I'm teasing. Anyway, hey, Mike, thanks so much. Be sure and get by the website. Be sure to like and subscribe to our channel. We appreciate it as always. And, if y'all just have your own conversation going on in chat, so I just leave y'all alone. But anyway, be sure and get by the website, realinvestmentadvice.com. Mike's latest article on AI and the electricity generation of power is on the website now. That's the third part. We'll have our newsletter out on Saturday. And tomorrow I've got a piece coming out on commodities specifically. That'll be on the website tomorrow at realinvestmentadvice.com. Have a great day.